Hello and thank you everybody for joining me. My name is Maxwell Loxton, student number S511343. I'll be presenting a stock pitch on REA Group. So my investment thesis is a buy-hold rating. My target price I've come to is $121 with the current market value of $112. REA Group is a historically strong brand, and their innovations and investments both offer huge growth and upside potential. So a little bit about the company. They're in the real estate industry in digital advertising. They have $928 million in revenue. Market cap is $14.84 billion. They have a P ratio of 38.6x. And the current stock price is $112. Their main revenue drivers include residential and commercial property websites, while also operating mortgage brokering franchises and property data services. A little bit more about REA Group. We can see that they're a multinational digital advertising business. They have operations and investments in Australia, India, Southeast Asia, and North America. We can see their main revenue drivers are Australia's leading residential and commercial property websites in realestate.com.au, realcommercial.com.au, and flatmates.com.au. They're also in Australian mortgage brokering franchises. We have Smartline Home Loans and Mortgage Choice. They're also the leading provider of property data services. And we can also see that they hold multiple strategic investments all throughout the real estate process. So they're a historically strong brand, as you can see. They have had successful growth for over 27 years since their inception. They are Australia's largest real estate advertisement provider, and as you can see on this chart, they're in the top 10 online brands in Australia. As you can see, they're only beaten out by other Australian brands such as ABC and eBay. Their innovations provide huge growth potential, but they're basically empowering more homeowners and creating a highly engaged customer base. They have 55 million launches of their realestate.com app monthly on average, and this has driven increased engagement and more people becoming sellers, refinances, or landlord prospects through their app. They also are supported by their loan tracker software, which allows customers to view and compare their home loans. So basically now we have more Australians tracking their properties and home loans to monitor the market and make more confident financial decisions. So there's definitely a lot of value there. Here we can take a look at their recent pivotal investments. They're basically providing market disruption throughout the real estate process. We have Mortgage Choice Acquisition, enhancing their exposure to $400 billion annual home loan market, and this creates a number 2 retail mortgage brokering leadership position with a 5% market share. They also have an investment in Property Guru, which gives them an 18% stake as the number 1 player in 4 of 5 key Southeast Asian markets. So to quickly go over the real estate industry for a quick analysis, so recently with gains in employment, growth in personal income, and record low interest rates, spending is even stronger, which has created an insanely strong real estate market. The growth in the real estate market since COVID has set a sales record of $9.8 trillion, which is massive, and we can see by this graph from CoreLogic, Q2 2022 has already shown a 25% increase in home sales since 2020. So quickly going over key risk factors, REA Group is definitely pegged to the Australian real estate market, which means a slowdown of the real estate market in Australia could be detrimental to the performance of REA Group. We also have more competition, so we have REA Group actively reinvesting into the company, which has created a healthy market share over its competitors. Though, if we were to reduce that reinvestment, we could pose a risk of losing that market share especially now that REA Group operates internationally. The last factor would be an increase in interest rates post-COVID. So after a period of cheap debt before and during the COVID pandemic, both the US Federal Reserve and the Reserve Bank of Australia are looking to increase interest rates. This would influence the flow of money into investments like real estate assets. This could obviously result in a period of underperformance for both the Australian real estate market and in turn REA Group. So quickly looking over some financials under profitability, we have a revenue of $928 million, net profit margin of 29% and $370 million in earnings. For growth, we have a 13.1% revenue growth year over year, with earnings forecasted to grow 13% per year, and earnings growth over the past year exceeds both its 5-year average and industry average. For liquidity, REA's short-term assets exceed its short-term liabilities, but it's noted that they do not cover their long-term liabilities. REA's net debt to equity ratio is considered satisfactory at 16.9%, and they have been able to reduce that from 51.4% to 32.1% over the last 5 years. So to go over the multiples and analyze them, we can do a relative valuation analysis. As REA is profitable, we can use the P ratio for this analysis, which is at 38.6x. So we compare it to the peers. REA has a good value based on its PE compared to all its peers. We can see in this table, I've just made a little table to compare PE ratios. We can find that the average is 41x. This is well and good, but our price to earnings ratio versus fair ratio isn't as good, as it shows us REA is expensive based on its PE compared to its fair PE. This takes into account forecasted earnings growth, profit margins, and other risk factors. We can also see that the price to earnings growth is poor based on the PEG ratio of over 1 usually being considered overvalued. So to take a deeper look, we're going to do a model price analysis using the constant dividend growth model. Next year's dividend per share would be $1.89 of expected dividend yield of 1.7%. If we use the CAPM and our projected growth rate, it shows us that this model would provide us with an intrinsic value of $63 per share, which would be trading at a discount of negative 78.5% based on the current market price. So what does this tell us? It means we cannot use this model to find its REA's intrinsic value. Why? Because REA's dividend is actually extremely low compared to the top 25% of dividend payers in the Australian market, so it'd be hard to find value from the dividend. So since our dividend approach was unsuccessful, we're going to use our two-stage free cash flow to equity model. So here I've plotted the next 10 years of free cash flows, and then we're going to use that to find the terminal value. Then we're going to discount it to find the present value, and then we're going to find total equity value and divide that by shares outstanding. So that brings us to an intrinsic value of $121 per share. This means that it is currently trading at a discount of 7.3% compared to our market price of $112. So what do we think the company is worth? After analysis, we would rate REA Group as undervalued. Looking at analyst ratings, we can see that the consensus is to either buy or hold, with an increase in buy ratings more recently. And basically we can see that through the intrinsic value and its current trading discount. So all in all, my recommendation would be to buy. Now we can see in the price graph that REA Group has gone through a bearish regression trend since January and is now May, and we've actually hit a support line which correlates with its price/support back in September, October of 2020. So if it were to hold this price, it would provide us with a good support band. I would hold a speculative long position, and I would add this stock to my portfolio at the current discount. Speculative because I would keep an eye on current real estate market trends and interest rate trends. But REA has a good value based on its PE compared to its peers. It's currently trading at a discount of 11.3%. Its earnings growth over the past year exceeds both its 5-year average and industry average, and pivotal investments are changing the way that we interact with real estate, mortgages, and data in Australia and Southeast Asia. So thank you for listening, and here are my references.